Welcome to Financial Assets. Companies raise capital in two main forms, debt and equity. In a free economy, capital, like other items, is allocated through a market system where funds are transferred and prices are established. The interest rate is a price that lenders receive and borrowers pay for debt capital. Similarly, equity investors expect to receive dividends and capital gains, the sum of which represents the cost of equity. Now, in this topic, we will be focusing our discussion about interest rates. Now, before we start the discussion, let me first ask you this question. Do you know how much does your money costs? Nowadays, there is no such thing as free lunch. Everything you do entails cost, just like borrowing from a bank. You don't only pay the amount you borrowed, but rather, you pay an additional cost of what you borrowed. Basically, the cost of money is the rental price of borrowing. Now, this rental price is commonly known as the interest. In a free economy, excess funds of lenders are allocated to borrowers through a pricing system based on the supply and demand of funds. Now, as you can see here in this illustration, the lenders provides excess funds to the borrowers, and in return the borrowers will pay such price, or what we commonly know as the interest or interest rate. Now here, the supply and demand of funds determines the interest rates. Okay, now the pricing system now is represented by the interest rates or the cost of money. Now, by providing these rates, the borrowers makes use of funds provided by the lenders. The cost of money is not just limited between the relationship of a lender and a borrower. In the case of equity capital, the cost of money is called the cost of equity, and it is consists of dividends and capital gains that are expected by the shareholders. Now again, dividends are those profit made by the company and chose to distribute to its shareholders, while the capital gains are those profit made by the shareholders through trading of securities. Now, to compute for the cost of equity, we have here dividends plus the capital gain. Now here is an illustration on how does the cost of money works. Now again, the cost of money works in two types of financial market. We have here the debt capital and the equity capital. Now in the debt capital, again, the provider here is a bank or it could be a cooperative. Now again, the provider will provide the money to a corporation or to a business, or let's just say an individual, and then such user will now pay the cost of money or what we call the interests. Now, in the case of equity capital, the provider here is now the stockholders. Now, the stockholders will put some money into a corporation, okay, that is also known as the user of the money, and then the corporation will now pay the cost of money to the stockholders, or what we call as the cost of equity. Now again, the cost of equity is both the dividends plus the capital gains. Now there are factors that affects the cost of money. We have here the production opportunities, time preference, risk, and inflation. First, we have here the production opportunities. Now, production opportunities are investment opportunities in productive assets or cash generating assets. So basically, when there is an increase in production, the demand of funds will follow. Thus, when there is an increase in demand, definitely the interest rates will also increase. Just like from the previous months, when the pandemic started, face masks, alcohol, and other hygienic necessities are on high demand, and the producers are unable to meet the demands of the users. Now, in such, the prices of the said products has increased due to its increasing demands. Now, the second factor, which is the time preference. So, this is when the preference of consumers for current consumption is opposed to saving for future consumption. So, basically, the demand of the consumer for funds for the current consumptions are high, then the supply of fund will definitely decrease, and as a result, the interest rate will increase and vice versa. Now, the third factor, we have here the risk. Now, in a financial market context, risk is a chance that an investment will provide a low or negative return. Now, going back to the basic principle in finance, we have here again the higher the risk in a security, the higher the return. Now, here when we have here the high risk, then expected that there will be a high return. And then now the interest rates will also follow. Now we have here the last factor, which is inflation. Inflation is the amount by which prices increase over time. Now, when there is an increase of inflation in the economy, definitely the consumers will tend to borrow more money or more funds from the provider in order to sustain its living. Now, in which in effect, the demand of funds will now also increase. And again, when there is an increase on the demand, the interest rates will also increase. We also have here the macroeconomic factors that could possibly affect the changes in the interest rates. First is the monetary policy, the business boom, the business recession, and the budget deficit and surplus. We have here the first factor, which is the monetary policy. Monetary policy, which is governed by the federal state, or in our case, the central bank. Now, interest rates changes when there is an increase or decrease in the required reserve ratio. Now, when there is an increase in the required reserve ratio, or the RRR, it means that there is a reduction in the volume of deposits. So basically, there would be a decrease in the supply of funds. So in which, when there is a decrease in the supply of funds, the interest rates will increase. While if there is a reduction or a decrease in the required reserve ratio, it means that there is an availability of excess deposits, and in result, there is an increase on the supply of funds, and when there is an increase in supply of funds, the interest rate will decrease. Now, another type of monetary policy here is open market operations. Now, an open market operations is buying and selling of securities from an open market. Now, when the central bank buys back securities from the open market, thus it is injecting money from or into the economy. Now, when the central bank injects money to the economy, definitely there will be an increase in the supply of fund. So basically, there will be a decrease in the interest rates. Now, in the opposite, when the central bank sells securities into the open market, thus the central bank absorbs money from the system. So basically, there will be a decrease in the supply of money, and thus there is an increase in the interest rates. The second macroeconomic factor is the business boom. This is a situation wherein there is an increased commercial activity within either a business market, industry, or economy as a whole. For an individual company, it means that there is a rapid and significant sales growth, which relates to the increase in demand from the market. Thus, it increases the demand of funds, which in effect the interest rates also increases. Now, on the opposite side of business boom, we have here the business recession. It is a situation wherein there is a general decline in the economic activity and there is a widespread drop in spending. As a result, the demand of funds will decrease, and when there is a decrease in the demand of fund, borrowing won't be attractive to the market. Thus, banks will decrease its interest rates in order to attract more users of funds. Now we have here the fourth and last macroeconomic factor, that is the budget deficit and surplus. Now a budget deficit happens when government expenses exceeds the revenue, and as a result, the government needs more fund for its various projects. Thus, there would be an increasing demand of fund, and therefore an increase in interest rate will also happen. While a budget surplus, on the other hand, is when the government revenue exceeds its expenses, so thus making the opposite of the budget deficit. Now, in summary, interest rates will go up when the demand of fund will go up. Demand, okay? And also, interest rates will also go up when the supply of funds goes down or decreases. Now we have here the determinants of market interest rates. First off, we have here the R, or this is the nominal rate of interest on a given security, or basically the interest rate of a security. Next, we have here the real risk-free rate. Okay, so this real risk-free rate is the rate that would exist on a riskless or risk-free security in a world wherein there is no inflation that is expected. Okay, now here, this is the risk-free rate. This is the quoted rate on a risk-free security such as T-bills or treasury bills, and then it includes a premium for expected inflation. So unlike the real risk-free rate interest rate, the risk-free rate, uh, there is an inflation added up to this rate. Okay. Next is the inflation premium. This is equal to the average expected rate of inflation over the life of the security. Next is the default risk premium, which is a premium that reflects the possibility that the issuer cannot pay or will not pay the promised interest or principal at the stated time. So that is why it is called default. Next is the liquidity premium, wherein the premium is being charged to the lenders to reflect the fact that some securities cannot be converted to cash on a short notice at a reasonable price. Lastly, we have here the maturity risk premium. So this is only applicable for those long-term bonds and even in the treasury bonds, which are exposed to significant risk on price declines due to increase in interest rates. And the maturity risk premium is also charged by lenders to reflect the interest rate risk. Now, here is a formula to solve for the interest rate of a given security. So we have here the real risk-free rate plus the inflation premium, or you can also write this down into R, okay, plus the default risk premium, plus the liquidity premium, and the maturity risk premium. Now let's have a sample problem in determining the different types of market rates or interest rates. First is if expected inflation during the next year is 2%, so that is the inflation premium, 2%, and currently the nominal interest rate on T-bills is 5%, so that is 5%. So since it is the interest rate on T-bills, we are here referring to the risk-free rate of the T-bills, okay? So that is R, And then the question is, what is the real risk-free interest rate? Okay, so we're looking here is for the real risk-free interest rate. So again, since we already know the equation for the risk-free rate, that is RF is equal to real risk-free rate plus the inflation premium. So since the risk-free rate here is already given, that is 5%, and then R, that is what we're looking for, and then the IP here is 2%. So we will just do the transposing. So 5% plus 2%, that is the R, or the real risk-free rate. So 5% plus 2%, that is 3%. Answer is 3%. Now, another problem is, if the inflation is expected to average of 4% during the next year and the real risk-free rate of interest is 3%, what should be the nominal interest or the nominal rate of interest? Now again, the equation for here is R is equal to real risk-free rate plus inflation premium plus market risk premium plus the default risk premium and plus the liquidity premium. Now, since um, the only given rates here are the following: the real risk-free rate, that is 3%, and then the inflation premium of 4%. Okay, so to solve that, R here is 3% plus 4%. So that is 7%. Okay, so we have another problem. So assume that the real risk-free rate is 2% and the average expected inflation rate is 3% for each future year. And then the default risk premium and the liquidity premium for bond X are each 1%. And the applicable maturity risk premium is 2%. Now, first question, what is the bond X interest rate? Again, the equation for the interest rate or the nominal interest rate is as follows. So R is equal to the real risk-free rate plus the inflation premium plus the default risk premium plus the liquidity premium and then the maturity risk premium. Now, since everything or all rates are given here, so R is the real risk free rate is 2% plus the inflation premium of 3% plus the default risk premium and liquidity premium of 1% each, so 1% for the DRP and 1% for the LP, and then 2% rather for the maturity risk premium. So add that up, that is 2 plus 3 plus 1 plus 1 plus 2, that is 9%. Okay, so the interest rate for bond X is 9%. Another question is bond X a treasury bond or corporate bond? So basically here, bond X is a corporate bond, okay? Corporate bond, considering that all premiums has been added to the real risk-free rate. Now, third question, does bond X more likely to have a 3-month or 20-year maturity? Now, considering that we have here the maturity risk premium, then bond X is a 20-year maturity. Okay? Because maturity premium is only added up when the security or the bond is for a long-term maturity. Okay? So let's see the answer. Okay? 9% interest rate, it is a corporate bond and it is more likely to have a 20-year maturity. Now, in order to justify the previous problem, in order for us to know whether such bond or such debt is a treasury or a corporate bond, we have here a table in order for us to know the different premiums that should be added up to the real risk-free rate for the different types of debt. Now, for the short-term treasury bond, the only premium that should be added to the real risk-free rate is only the inflation premium. Now, for the long-term treasury bond, the inflation premium and the maturity premium should be added. Okay? For the short-term corporate bond, inflation premium plus the default risk premium and the liquidity premium is added. While in the long-term corporate bond, all premiums in the equation that are these are the inflation premium, market premium, and the default risk premium and the liquidity premium should be added up to the real risk-free rate and should be considered as a long-term corporate bond. Now we have here the term structure of interest rates or the yield curve. Now we have three kinds of yield curve, that is the normal yield curve, abnormal yield curve, and the humped yield curve. Now for the normal yield curve, that is an upward sloping, and then the short-term interest rates are lower than the long-term interest rates. Now, here in this graph, the normal curve is this one, okay? This is the normal curve, normal yield curve. And then another yield curve is abnormal yield curve, that is a downward sloping. So short-term interest rates are higher than the long-term interest rates. So as you can see here, in this March 1980, this is the abnormal yield curve. So since the short-term interest rates are higher than its long-term interest rates, okay? And then lastly, we have here the humped yield curve. That is the interest rates on medium-term maturities are higher than both the short-term and the long-term maturities. Now, as you can see here, in the intermediate or the medium-term dates or years, the interest rates are higher than the short-term and the long-term. So basically, this is the hump yield curve. Now we also have here the determinants of the yield curve. So first is the inflation, which the market expects inflation to increase in the future. So the inflation premium will be higher on a 3-year bond than a 1-year bond. So on the other hand, if the market expects that the inflation to decline in the future, long-term bond will have a smaller inflation premium than the short-term bond. And then second determinant is the maturity or the maturity risk premium, which also increases with the maturity. So the longer the maturity, the higher the maturity risk premium is. And then the yield of a treasury bond which matures in T years can be expressed as follows. So R, or the nominal rate, is equal to the real risk-free premium plus the inflation premium plus the maturity risk premium. Now let's have a sample problem for that topic. Suppose most investors expect the inflation rate to be 5% next year, 6% the following year, and 8% thereafter. And then the real risk-free rate is 3%. Then the maturity risk premium is 0 for bonds that mature in 1 year or less, 0.10% for 2-year bonds, and then the maturity risk premium increases by 0.10% per year thereafter for 20 years. Now question, what is the interest rate for 1 year, 10-year, and 20 years treasury bond? The first step is to find the inflation rate or inflation premium for n years. So again, the problem says that for each of the bond, we will find the average expected inflation rate over year 1 to year n. So here is the equation. So assume that the inflation rate is to be 5% next year, and then 6% the following year, and 8% thereafter. Now, for the inflation premium for year 1, we only have 5% divided by the n. That is 1. So we have here 5%. For the inflation premium for 10 years, we have here the 5% plus 6% and then 8% for 8 years, right? Because 5% for year 1, okay? 5% for year 1, 6% for the next year, okay? Year 2, and then 8% for year 3, and so on. So since we are looking here for the inflation premium for 10 years, and then we already have the inflation premium for the first 3 years, we only have to get the remaining 7. So since year 3 up to year 10, it is consistently 8% for the inflation premium. So basically, we have here 8 years for the 8%. So divide it by 10 years, we have here the 7.5%. And then for inflation premium for year 20, we have here again 5% for year 1, 6% for year 2, and then 8% for the remaining years. Now since again we have here the 5% and the 6% for year 1 and year 2, then the remaining years should be 20 minus 2, that is 18. So 18 years, 8% will be the inflation premium for 18 years. So divide it by 20. So we have here an inflation premium of 7.75%. Now, next step is to find for the maturity risk premium for n years. Now, we should find the appropriate maturity risk premium, or MRP, for this example. The following equation will be used to find a security's appropriate maturity risk premium. So MRP is equal to the rate given, or the 0.10%, multiplied by t minus 1, that is the year, minus 1. Now, using the given equation, for MRP for first year, we have here the 10%, and then the t is 1 minus 1, so we only have 0%. And then for the 10-year na MRP, we have here 10% multiplied by 10 minus 1. So that is 90%. And then for the maturity risk premium for 20 years, we have here the 10% multiplied by 20 minus 1. So we have here 1.90%. Now, since we are already done in looking for the inflation premium and the market risk premium, we will now be finding the interest rates for the treasury bonds for 1 year, 10 years, and 20 years. Now, first is, again, we will go back to the equation for the nominal rates for the treasury bonds. So again, that is the real risk-free rate plus the inflation premium plus the maturity risk premium. Now, so for year 1, again, the real risk-free rate for all years is 3%, right? And then the inflation premium for year 1 is 5%. Add it with the maturity risk premium, rather, of 0%. So basically, that is 3 plus 5, that is 8%. Now, for the year 10, the inflation premium here is 7.5%, and then the maturity risk premium is 90%. So the risk-free rate here is, or the nominal rate is the 10%. 11.40%. Now for year 20, the inflation premium is 7.75% and the maturity risk premium is 1.9%. So 3 plus 7.75 plus 1.9, that is 12.65% interest rate for the treasury bond. So that's it for the interest rate topic as part or as the first topic for the financial asset. So I hope you've learned something from this discussion and study in advance for your finals and semifinals. Thank you.